Hello everyone. Today let's understand different asset management companies in India. Firstly, we will understand the broad spectrum of the industry, how the industry is positioned to capture the growth of a developing economy like India. And also we will get into different players who are part of AMC industry in India. There are multiple AMCs which are available in Indian market. Will not go into each of them. Will understand as an investor only the listed players available in the Indian market. So with that, we will get into the analysis. Firstly, we will understand the total addressable market, that is the opportunity which lies in front of us as retail investors to capitalize on growing trend towards financialization of savings in a country like India. Also, we will understand the size of the opportunity which is there in front of us. There are multiple tailwinds as well as headwinds which impacts the growth story of AMC industry. We'll understand both. As I said, there are multiple listed as well as unlisted players operating in Indian market which have their mutual fund house. Will will decode as to how those players are performing, and as an investor it makes sense to buy them or not. Also, we will speak about the current valuations of those different players and see whether there is an opportunity to enter in those companies or not. In terms of size of the opportunity, the industry asset under management has been growing quite steadily. As we can see from 2013 onwards, there has been a significant or accelerated growth in terms of asset under management. So there is clearly a trend towards financialization of savings and equity coming out as a preferred asset class for many retail investors. You can also observe that there has been a trend of high single digit growth in certain span of time, and also mid to high double digit growth in certain duration. This happens because there is some element of cyclicality involved in stock market. Moving on, if we compare the size of asset under management in India, that is, if we combine the total assets which AMC companies have in India, that comes out to be around 16% of total GDP of India. So that's quite small in terms of if you compare that against developed economies like United States, United Kingdom, Sweden, Canada, and rest of the world. For example, you can see in United States, mutual fund asset under management is even higher than its GDP. So that means that market capitalization of all these companies is much higher in United States as compared to their GDP. If you also see, a developing country like Brazil has a very high penetration when it comes to mutual fund industry. 77% of assets under management is with mutual funds in a country like Brazil. Hence, you see a very high financialization of services which has happened in Brazil. For India, there is still a very long runway when it comes to penetration for asset class like equity as well as different asset classes like debt, ETFs, etc. In terms of total size of the population, almost 3% of the Indian population invests in mutual funds. So that leaves a big room of growth for mutual fund companies in India. And that trend is slowly and steadily uncovering. Moving on, if we compare the growth of mutual funds or AUM, asset under management, with these different mutual funds, it correlates with the nominal GDP growth rate of India. For example, nominal GDP growth rate of India was around 13% in the year 2013. Uh, since then, it has been quite steady. In COVID years, it has declined, but it has kept up pace and it has been in the low single digit. So, current GDP of a country like India is around $3.5 trillion, and it is expected to grow to at least $5 trillion in next 5 to 6 years, and in next 10 years to around $10 trillion. So there is a big scope in terms of growth for mutual fund companies in India, as well as certain reforms and policies which have come together, which has led to formalization of Indian economy. Reforms such as GST, Insolvency and Bankruptcy Code, RERA, have paved the way for sustained growth and more formalization of Indian economy. With these reforms in place, retail investors are better placed to invest in companies which are operating in organized space in India. Also, policies like PLI, National Infrastructure Pipeline, Make in India initiatives are leading to a thrust in terms of growth for logistics, manufacturing, and defense and services industries in India. India has also jumped to a very higher position in ease of doing business ranking in 2020. This is a clear trend in India when it comes to financialization of savings. As a traditional way of life, Indians have been investing heavily into gold and real estate. As per RBI's account, almost 90% of an individual's wealth is locked into real estate or gold, and 10% is only invested in bank accounts and debt. That is slowly and steadily changing. More and more Indians have started to realize the power of equity as an asset class, and more Indians are participating in the growth journey and growth story of India by investing in different companies which are available in the index as well as in the broader market. Growth of demat accounts has also gone up. Since 2020, the growth has been tremendous. Almost doubling of demat accounts has happened, and that journey is slated to continue in future as well. When it comes to tailwinds, definitely there is under penetration when it comes to mutual fund industry. Less than 6% of the Indian population invests in equity funds. There is huge demographic dividend which is slated to get unlocked. Average age of Indians is around 28 years. So that means that most of the Indians are in the stage where they can work and grow Indian economy. That is highly beneficial for listed companies in India, that they don't have to search for talent pool outside of India, and they can get access to labor market in India itself. So that leads to a consumption led growth story, as well as that leads to increased availability of manpower, leading to revenue increase as well as profit increase. When it comes to asset class, equity has proven track record of being a long-term wealth generator for its investors. When it comes, if we tally the math from 2000 to 2020, for example, equity has given almost 12 to 13% CAGR return year on year, beating all other asset classes like real estate, gold, debt, etc. The story of equity penetration as well as mutual fund growth is slated to continue because per capita income of India is $2,400 per year. That is very low when it comes to countries like China, United States. For China, it's around $12,000 per year. For USA, it's around $20 to $25 per year. So definitely per capita income of India is slated to increase. With that, discretionary spend and access to luxury items is also going to increase. What that means is a lot of Indians are going to come out of poverty and also going to consume different goods and services available in Indian marketplace. That would lead to increased revenues and in turn increased profits for different listed players in India. Formalization of Indian economy is slowly and steadily happening. Most of the Indian economy is informalized at this point of time, but with these reforms and like GST, RERA, JAM Trinity, a lot of Indians are their businesses, small businesses and medium enterprise businesses are getting formalized, and they are creating more and more wealth uh, for their consumers, as well as with by paying taxes they are leading to increased revenue growth for Indian government as well. Also, easy accessibility of mutual funds, its promotion strategy, online access to buy and sell orders by different broking sites, and recommendations, huge amount of influencers creating awareness amongst Indian masses to access Indian equity via different sources, via different broking platforms, has created a kind of trend for young investors, and they are getting into this bandwagon and contributing to growth in market capitalization for various companies, as well as growth in the domestic purchase of different equities for different companies. When it comes to headwinds, high interest rates definitely impacts equity as an asset class. Though equity as an asset class is known to beat inflation at all points of time, but increased interest rates sucks out liquidity in the system, and that basically transfers that leads to some of the FIS and DIS moving towards safe havens like treasury bonds, as well as debt assets. Impending US recession in 2023 has caused a lot of worry for investors. Though Indian market has remained steady, has not fallen by more than 8 to 9%, but this one headwind can lead to spillover effect if US economy goes into a tailspin, and if it gets impacted because of high credit limit, as well as high inflation, which impacts their economy. Equity as an asset class is cyclical in nature. If there is a period of boom, it lasts for almost couple of years, then there will be a period of consolidation, then there could be a short term duration period of uh, bear scenarios as well, where equity as an asset class gives zero to no return, or negative return as well as at times. So it is essential for retail investors to hold equities in their portfolio for a duration of minimum 3 to 5 years, because that's the duration where a complete cycle gets completed, and as a retail investor one can get benefits out of waiting in the cycle, and in turn reaping benefits at the end of the cycle. So equity as an asset class is cyclical in nature, not just in India but in any other market in the world. Now let's do comparative analysis of different players who are operating in mutual fund space in India. I have not listed down all the players in this bucket, but let's understand the major players who are operating in as AMCs in Indian market. So total size of the industry, total asset under management for mutual funds is 40,000 billion rupees, and bulk of that amount is evenly split between equity and debt. Equity is slightly on the lower side and debt on slightly on the higher side. SBI Asset Management Company is the biggest player in the Indian market. SBI has a vast network of different banks, and it is one of the oldest banks in India. Definitely state owned, center owned bank, but it has been there for quite some time. It's one of the earliest entrants when it comes to AMC business in India. That holds a significant market share of 18% when it comes to asset under management in mutual fund industry, and that is also steadily growing year on year. ICICI AMC comes second, which has 12.3% market share and is also growing steadily. So the growth rate of for these AMCs varies between 6 to 12%. In good years, they grow by around 12 to 13%. In not so good years, in dull phase, they grow their AUMs by about 6 to 8%. HDFC AMC is the third largest AMC company in India. It has 54% of its AUM in equity and 46% of its AUM in debt. Now, there is one thing to consider here. When it comes to equity, managing equity is difficult because there is volatility and risk associated with equity as an asset class. So you need to have a skilled asset manager, fund manager, to manage the lows and highs of different stocks in your equity basket. And hence, for that, AMC companies charge an expense ratio to the tune of 0.2% to almost like 2.5%. So equity as an asset class or equity mutual funds are beneficial for AMC companies so that they can charge higher expense ratio. In debt mutual funds, you don't get to charge high expense ratios. The reason is simple, because in debt, the asset manager is not required to do too many things, not required to do too many transactions. Hence, expense ratio is quite low for the debt mutual funds. For equity mutual funds, definitely expense ratio is on the higher side. And also when it comes to small cap and mid cap, since this requires specialized attention to stock picking, fundamental and technical analysis, that's where the expense ratio is also on the higher side. So hence, if you see a company with higher mix of equity than debt in its AUM, that companies should be doing well in terms of revenue growth as well as profit growth. So HDFC AMC, if you can see, stands well, has a higher composition of equity as compared to the industry ratio, and comparatively lower percentage of debt in its overall AUM. Fourth company in terms of AUM size is Nippon AMC. This is also a listed player in the Indian market. It commands 8.9% market share, and it's one of the biggest player in ETF exchange traded funds, which have very low expense ratio and are very liquid and available for transactions. So Nippon AMC ETFs like Nifty Bs, ITBs, they command a lot of market share, almost 30 to 40% market share when it comes to ETFs. But they do earn less because ETFs basically track the index, and hence you don't need a skilled fund manager to do that, and hence you can't charge high expense ratios on such products. Aditya Birla AMC is the next in line with 5.6% market share, has been significantly growing. It's one of its key product is ELSS, Aditya Birla Sun Life, which is like which in its category is number one, and has a very good AUM for that particular product. UTI AMC is also one of the prominent players. It is one of the first AMCs to be available for retail investors in Indian market. It commands a market share of 5.89%, and UTI AMC especially has a good amount of assets coming through NPS route, because it is one of the prominent fund managers in NPS along with SBI AMC. So UTI AMC gets a lot of its funds via NPS route, and hence you can see 67% of its total asset under management is with equity based mutual funds. and only 33% is with debt set of products. So overall, when it comes to the industry is slightly cyclical in nature. Uh, when there is a period of lull, then the stock will not go anywhere, or will almost go down. But when there is uptick in the market, when there is market growing at a rate of 15-20% in a year, you can see that asset under management also jumps quite a lot. And in the period of bull, a lot of retail investors also participate in the market. They increase their SIP flows as well. Hence, asset under management grows quite steadily during those periods, and hence the profit also grows quite steadily. Also, this is a highly scalable business because you don't require, say, if you have one fund manager managing funds for 100 investors, that same fund manager can manage funds for 1,000 investors as well. So there is a lot of scalability available in the business. Hence, there is a lot of operating leverage, and these companies have very high margins to the tune of 65 to 75%. So whatever money comes in sales, more or less translates into higher profits as well. So there is a lot of high operating leverage when it comes to these companies. And also these companies gives very good dividends. When it comes to HDFC AMC, at current market price, its dividend yield is around 2.3%. UTI AMC is also a very good dividend paying company. It gives dividend of around 3.3%. So these companies also give good dividends. So overall, if I were to summarize, the growth rate of the mutual funds in India is in high single digits, and in bull scenarios, lower double digits to mid double digits. Most of these companies grow at the industry rate. Some private players like HDFC AMC, ICICI AMC invent a lot of products, and they have slightly upper edge over other AMC companies here, and can grow at a higher rate. So amongst these companies, ICICI AMC is not listed. SBI AMC is also not listed. These companies are part of their respective banks. HDFC AMC is a listed company. Nippon AMC is also a listed company. Aditya Birla AMC is also a listed company. Even UTI AMC is. So these listed players gives us opportunity during these times to enter, and as a retail investor, we can take positions into these companies, but be aware of the cyclical nature of these companies. And it's good to time entry and exit in these companies, and which can help in creation of quick wealth, if that's the time that's the expectation for the retail investor. But when it comes to long term wealth creation, these companies will track normal GDP growth rate and are slated to grow at around 11 to 12% year on year over next few years. So that's the analysis when it comes to mutual fund industry. If you have any questions, do let me know. We'll be more than happy to answer those questions. Thank you.